Welcome to Smart Franchising with FranSmart. I'm Dan Rowe, and I've masterminded the ascent of local favorites to global dominators. This isn't your usual get-to-know-you chat. We're diving deep. We're revealing the raw truths about franchise wealth building. With over 30 years in the trenches, I'm spilling it all. If you have an appetite for unfiltered tales and the hidden blueprints of franchise prosperity, buckle up. We're diving in. Welcome back to Smart Franchising with FranSmart, and today I'm lucky enough to have one of my idols and mentors on the podcast, the most restaurant-appropriate name in the business, John Hamburger from Franchise Times, Restaurant Finance Monitor, and the one conference a year I never miss, the Restaurant Finance and Development Conference. John, thank you very much for joining us today. You're an objective third party with the most ideal macro perspective on the business, and you've seen it all. We want to talk to you about secrets of success in franchising, who's doing it right, who's suffering, and your predictions for the future. So with that, John, give us your story. Tell us how you got started and how you built your ecosystem to where it is right now.
Well, thanks, Dan. Thanks for having me today. I'm excited to be here. Dan, I was a CPA, started out working for Arthur Andersen back in the day. And the first job out of public accounting was with the restaurant company. We were a franchisee of Chi-Chi's Mexican restaurants in the Midwest. And the company was called Council Corp. I started as the controller and worked my way up to be the CFO. And I got involved in doing a lot of financing of restaurants, sale-leaseback, bank lending, you name it, we did it. We needed to raise money to build restaurants. So I kind of like doing that. So I left the company in 87, started a little, I don't know, you'd probably call it a boutique investment firm that helped restaurant companies find financing. And that's what I did for 4 years. And I started a little newsletter at the time called the Restaurant Finance Monitor. And it was designed to get me business for the firm. And then I started a conference called Restaurant Finance and Development Conference back in 1990. We held our first one in Chicago, and incrementally grew that little bit by little bit each year. And in the mid 90s, there was a magazine that I had read and came across called Franchise Times. And I got to know the publisher of that magazine fairly well. And one day, in the probably around 1997, 98, he called me up and he said, "I'm no longer with the company. They're closing the magazine down." And I said, "What? How can they close that down?" And anyways, I through a number of different phone calls, about 6 months later, I bought it, Franchise Times, and published the first issue of Franchise Times in January of 1999. So I've been publishing that for 25 years. So what started out in franchising and financing, I'm still doing it today, but I'm doing it through the publication route, not the investment banking route. So that's my story, Dan.
Nice. Well, I've been going to your conferences for probably 30 years. So I'm glad that you have it. But so tell us what's going on in the business right now. I've been in this industry 30 years, maybe 32 years. Every year there's some sort of a headwind, and half the people talking about how tough it is to make money in the industry, but it keeps chugging through. We keep figuring out how to make money, but tell us what's going on in the industry.
Well, I think you're absolutely right. There's always something. I look back in the 80s, there was an oil crisis, there was a real estate crisis, there was home prices collapse, there was inflation. In the 90s, we had the dot-com, late 90s, the dot-com crash. We had the financial crisis. We had COVID. We've had inflation. We've had so much, and it never seems to kill the urge to eat, right? And I think restaurants have been able to adapt and have been able to reinvent themselves. And I know in my line of work, I might talk to somebody today that's having a hard go of it, but tomorrow I talk to somebody else who's killing it. And it's just the way the industry works. It depends on when you got in. depends on your passion, and we just keep inventing different restaurant concepts and different types of service. And it's probably one of the most entrepreneurial businesses that there was ever invented. And it's just fun to watch people adapt to the different economic times. And that's what I love about it.
I remember a long time ago, maybe 20 years, I heard you talk about unit economics and unit economic models and kind of your rules for success. And they had to do with sales to investment and capitalized, non-capitalized. But what's sort of your 2024 prism for what you think a concept needs to have right now for unit economics?
Yeah. Well, years ago, there used to be kind of this simple rule of thumb. It was called the sales to investment ratio. And what you did, Dan, is you took the total costs of a restaurant. And, back then people were building them. So you'd take the land, the building, and the equipment. And let's just say that adds up to $2 million. Well, assuming the restaurant had normal margins, you'd say your sales in that restaurant would have to be at least 1-to-1 or better. And, I go back in the early 80s, we had Chi-Chi's restaurants that were easily 2-to-1, 2.5-to-1, using that ratio. And now somebody will say to me, well, John, Chi-Chi's isn't even around anymore. Well, I think what happened is people forgot about that ratio and started spending $3 million to do $2 million. And when the sales start to come down, as they inevitably do, I think, in a lot of restaurant chains, concepts keep building. So I still go back to that formula. Now, a lot more property is leased today than owned. And so what you do is you'd capitalize the lease and add in the cost of the equipment. And where do your sales shake out? And I would tell you that if your sales shake out on a fully capitalized basis, less than 1-to-1, and you keep building stores, you are not going to have a very successful experience in investing in restaurants. And so I still follow that today, Dan. And a lot of operators look at all sorts of different things: return on this, return on that. You can take a look at the income statement of a particular restaurant and what is its bottom line? Is it 20%? And what's it 20% after? Is it 20% after the marketing spend for that store? Is it 20% after the G&A spend? Is it 20% after depreciation? That's if I could find a restaurant that maybe we'll say the EBITDA is 20% or greater, that's pretty good. That to this day, that's pretty good. And when you start to get below that, you start to get down to 10%, 5%, 2%. You're on a downward cycle. And so those are the two things I look at. What's the sales to investment and what's the store level EBITDA? Those are the unit economics I look at. And I think in franchising, that's what a franchisee has to look at. They gotta take a look and see exactly what kind of return they're going to get. And I think in the long run, that's what determines it.
Yeah, I think with franchisees, they have to be so happy and so profitable that they want to keep opening up more, right? Because it's one thing to get them to sign up for a territory. You get somebody to sign up for 5 or 10 or whatever. By the time he's been open a year, I mean, he knows everything the sales reps can ever say. And if he's not so profitable that he wants to keep reinvesting, you're dead. I mean, that also sends a bad message to other prospective franchisees that existing franchisees aren't growing. And I mean, nowadays, with all the headwinds in the industry, I'm looking for concepts that return capital 2 years, 3 years max. Otherwise, because you have to keep reinvesting in restaurants, not just the depreciation issue, but restaurants get banged up, especially if they're busy. So you're constantly pouring money back into the restaurants. But
I think that's
2-year payback.
Yeah, I think, Dan, that you mentioned payback as another calculation that you can do is how quickly do you get paid back? I mean, really get paid back. I mean, if you put up $1 million to build a he put about $1 million in new cash to build a new restaurant or open a different franchise. How quickly do you get that back? And that's really important too. And it's a franchisee. When you see the franchisees building stores, that's really a good sign, isn't it?
Yeah. Hey, so think of some of the most successful franchisors and what they do to succeed. When I think of successful franchisors, really the barometer for me is, are the franchisees happy and keep reinvesting more stores, right? And so I think of Five Guys. I was lucky to be part of Five Guys. Like, that's a runaway freight train. But I also think about people like Jersey Mike's. Like, I've never found an unhappy Jersey Mike's franchisee. But
what Jersey Mike's a great example, because during COVID, Peter Cancro paid for a lot of the remodels in that system. You don't see many franchisors doing that. But I think the thing that's really important, Dan, is for the franchisor to recognize that it's really all about the unit economics of the franchisee. They're going to be the ones that, they're going to be the ones that are going to be successful, are the ones where the franchisees are making lots of money. And I think sometimes franchisors lose sight of that, and they think about other ways they can make money, through supply chain, through maybe the advertising fund, which they're not supposed to touch. But I think that when they really are zeroed in on what the franchisees are making, and really care about it, really concerned about it, they'll laugh all the way to the bank.
The real payoff, I mean, even when a brand, you mentioned brands getting kickbacks and rebates, it's like you shouldn't even be thinking about that until you have hundreds of locations open and lots and lots and lots of buying power. When you're trying to get overrides on a 10-unit chain off of every franchisee, that's a fool's errand. Your franchisees, I mean, you're going to make no money. The amount of money you'll make on it's not a lot. All the real payoff in this business is when a chain gets past 100 units or 100 million in system sales, all the way. I mean, as far as it grows past that, it's all in the money. Or when a company sells, right? A company sells. But then you think about what are some of the, and I do want to get your thoughts on this. What are, like, of the concepts that have sold for big multiples, like, what are some of the reasons why these companies sell for big multiples? That's the only thing a franchisor should be thinking about.
Yeah. Well, I think that there's a cycle there too, Dan, and it has to do with how much capital is available. And I think we saw a lot of big multiples over the last 10 years because there was a lot of private equity money that came into the space, a lot of investors, looking to buy franchisors. It's a hot little area. They're creating a lot of platform companies where they have multiple franchisors under one company umbrella. It's a hot buy. And so I think a lot of those multiples crept up during that. But I think it really depends on the growth. If you're a franchisor, what's the growth of that royalty stream, and how quickly is that growing? With new units coming on, and also with average unit volumes that are growing. That's really where there's value and why they're willing to pay these multiples. And I think there's another part of it too, Dan, and that's the there is something to this asset light model if you're a franchisor, and you're not spending a lot of money on capex. Your franchisees are doing that, and those ones that have been able to get those franchisees to grow and to grow sales, they deserve those big multiples.
Yeah. I mean, you think about the franchising's almost sinister. A franchisee prepays you to come in the system. They pay you to stay. They pay the capex. They sign the personal guarantees on the leases and the loans. And all the franchisor has to do is stay out of their way and not screw up that model that makes them want to keep opening up stores.
Yeah, and that's sometimes tough for them to not screw up that model, because it is a lucrative situation for them, and they've got to be, really zealous that they focus on unit economics and think about those franchisees, or it can go sour pretty quickly.
Hey, what are some of the brands that that are thriving today in 2024 with all the headwinds, and why do you think that they're thriving?
Yeah, well, let's think of some of the big brands. And that a big brand that's been around for a long time continues to thrive is Dunkin', and it's just a great brand, and with some great franchisees, and that's one that I look at that's really been strong, and everybody points to, since we came out of COVID, some of the ones like Chick-fil-A and Raising Cane's have really done well. I mean, these are Chick-fil-A's average unit volumes on a freestanding store are over $9 million. I mean, it's incredible.
6 days a week.
6 days a week. You drive by a Chick-fil-A. I don't care what time you drive by. Their drive-through lines are absolutely packed. And, they're such a smart company. It's got such a unique, I don't know that the product is that unique. The chicken sandwiches and the chicken fingers and whatnot. I don't think it's all that unique. It's just the way they go about executing, I think, is great. And Raising Cane's is a unique situation too. In fact, they quit franchising. They've been buying back the franchisees. So I think of those. I think of Dunkin'. I think Popeyes has done a pretty good job. I mean, I think McDonald's has done a pretty good job. They've kind of got a bad rap here with all this talk about the value wars. I mean, I've been in this restaurant business for 44 years, and there's times when you can charge full price. There's times when you have to provide some sort of value offering, and I think that's the time we're in right now. And I think McDonald's will figure it out. They do a really good job. Those are the ones I think of on the big brand side. On the small brand side, I mean, you mentioned Jersey Mike's. What a success story there. I remember when Jersey Mike's had maybe 100 stores, and they really weren't going anywhere. And I think a combination of Peter Cancro and picking up some great people, Hoyt Jones, Brian Summers, some of those people are just outstanding, and that's what drove that business ahead. And there's been some great stories in franchising. Jimmy John, the success he had building that sandwich chain is just I hope someday Jimmy writes a book, because that's a great story too.
I want it to be an audiobook, because anyone that's heard that guy talk, he's a riot.
There'll be Dan. It'll be an audiobook, but they'll have to blip out a few things.
They'll have to blip out a few things. What do you make of even today? What about that Dave's Famous hot chicken or whatever that thing's called? Like, that's another runaway freight train. It's grown in. It all started in the last couple of years, but then it's super popular. You talk to the franchisees, not only are they opening more, they're buying more territory. So in all the 2024 headwinds, these franchisees keep doubling down.
Yeah. Well, that's a good sign, Dan. I want to find out in 5 years if the franchisees have made as much money as they think they're going to make. That'll be the big the end of the case study, I guess.
Well, you're dubious because we've both seen so many headlines of concepts that predict big things for themselves and then are gone in a couple of years. But
hell, I worked for one. That's what Chi-Chi's was. Chi-Chi's was the hottest casual dining concept, from the late 70s until, they kind of started to flame out in the mid 80s, mid to late 80s. And, I think they were gone, by 2000. They're now a trademark owned by Hormel, and it was one of the hottest brands ever. And, I think, that's why I think you gotta put a little bit of, longevity on some of these and see how they do. I'm not saying I'm skeptical of, Dave's Hot Chicken. I'm just saying, jury's still out.
Yeah. Hey, so who's suffering now? You don't have to name names, but like, what kind of brands are suffering right now? Who's sort of taking it on the chin, and why do you think that is?
Well, I think some of the legacy brands, older brands, ones that are pushing 40, 50 years, I think it's tough if your physical plant hasn't kept pace. And, I think of Pizza Hut. I mean, Pizza Hut was cutting edge, really was. and they made the decision to move away from the red roof type restaurant to the Delco unit, the delivery and carryout units. And they were ahead of their time back in the late 80s and early 90s. And just to watch sort of Pizza Hut, get overtaken by Domino's and by so many different up and coming pizza brands is really a shame. I mean, that's one where, if you wanted to be wealthy as a franchisee, you had to be in Pizza Hut. And nowadays, I don't think that's the case anymore.
Yeah. What do you see is still challenging right now? Like, what challenges do you think that the restaurant folks are having right now?
Well, they have a lot of challenges. I think right now, there's and I'll tick them off for you. First thing is labor. Just trying to find good employees is very difficult. It's been difficult for a long time. Years ago, franchisees relied a lot on teenage labor, and they made the decision to move to full-time workers. And it's tougher. It's full-time adult workers want more money, and it's just a tough situation trying to find labor, good employees. And that's really the franchisees that have figured that out are the ones that are going to be successful. The second thing is I look at the gyrating costs of, let's say, food. Well, that's been going on as long as I've been in the business, so I don't really think of that as a big deal. People complain about it, but they go up and they go down. And the beauty of the restaurant business has been the ability to raise menu prices, to be able to adjust your menu when you're faced with cost problems. Another factor right now that I think is going to impact franchising in the future is the cost of construction. Build outs are so much more expensive now. Try calling a plumber. Try calling any kind of contractor. I mean, they're busy. They've jacked up their rates. You've got a lot of baby boomer plumbers and electricians who've retired, and it's more expensive to build today than it was. And so that's a factor. I think that so if I was to put on my negative hat, those are the things that I see that are challenges.
Yeah, cost of everything's going up. I mean, but as long as I can remember, in the 30 years, the cost of it never went down. Like, it doesn't cost any less to build per foot, or food cost hasn't, so you just have to engineer a menu that's more profitable, that takes less labor, so that you can overpay your staff and do all those things. But it's tough.
Yeah, and some have been able to figure that out. I mean, you look at Chipotle. Now, Chipotle is not a franchisor; they're all company owned. But Chipotle's got the lowest food costs they've had in ever, but they still value on the plate at Chipotle. So they're doing something right.
Yeah, it's £1.50 of food. So, hey, so we probably get 2 or 3 companies a day coming through our website saying if we would help them franchise. Almost none of them have good unit economics or economics that would support franchising. But what sort of advice would you give somebody thinking about franchising their business? I don't think someone should unless what?
Well, I get that question all the time too, Dan. And I think what happens is somebody develops something. It could be a restaurant. It could be a service franchise of some sort. And somebody says to them, "Hey, you should franchise. Maybe you should franchise it." And so I've been asked that question a lot. I've gone to many IFA conventions where I've sat with prospective franchisees, and I might be the guy that's the Debbie Downer, because if you think of, we'll just say the IFA convention, it's all about franchising. They like young franchisors to franchise. And I'm going to give you 2 examples. I had a guy about 10 years ago. He had started a small restaurant concept in one of the boroughs of New York, and he was a former fireman, and he had built 3 locations, and And one of them was pretty successful. The other two were mediocre. And somebody got in his ear and said, why don't you franchise? So he came out to the IFA convention, wanted to learn a lot about franchising. And I told him, I said, that would be the biggest mistake you ever made in your life. I said, because A, you haven't proved it outside of a particular area, which I think is really important to franchising, is to be able to show that it travels, so that a prospective franchisee knows that it's worked in a different market. So I told him not to franchise, and I'll never forget. He said to me, he goes, you're the only guy that's told me that here. And I said, well, maybe I saved you some headache and some money. And then
some lawsuits.
And then the second one is just this past IFA, I was sitting with a couple that had opened up a franchise in a Texas city and had decided they wanted a franchise. So they were there talking to attorneys and whatnot, and they had never taken it outside of that city and the product they were selling, the service that they were selling wasn't really anything unique. It just wasn't unique. And so then I said to those people, I said, I would at least try it, this concept, at least once outside of the city you're in, and see if you can manage it, see if it can work before you spend any money on franchising. So I like to look, does it have something that's unique? Are the unit economics good? Is it something that would travel? And those are very simple. They're simple, but that's how I would advise somebody.
Good. Well, let's shift gears a little. So do you see brighter days ahead for the rest of this year and next year, or no? And why?
I do. And the reason I do is that, the beauty of business, I guess this is the beauty of capitalism, is the ability to adapt, the ability to adjust, and under changing economic circumstances. And that's that creativity that comes about when, let's say the economy is down. That allows you these incremental changes that you can make to your business, to your concept, to whatever, that when the market turns and when the economy changes, you're in good position to take advantage of it. So that's the beauty, and that's what I like about franchising is, a lot of creative folks coming to a lot of great solutions to try to get better, to try to improve. And through my life in business, I've been through, like I said in the beginning, so many cycles, and those concepts that work it when the times are tough, can come out of it just great. And that's why I'm always optimistic about franchising and where the economy is headed.
Yeah, me too. I mean, on the food side, you think about it, everyone wakes up hungry. They're going to eat somewhere, right? So it's the restaurant's job to make them want to eat with them versus whatever all their options are. But hey, talk about the access to capital right now. How easy is it for somebody to get a loan or to go get investor money? It seems like that's gotten tighter lately.
Yeah, it's definitely gotten tighter. And, again, I think that the capital markets go through this cycle of, no money. Okay, we might give you something. Okay, what do you need? Oh, hey, pay me back right now. Oh, I'm going to default you. We're open, but we're really closed. And isn't that right? I mean, that's how it works. And I think that we're sort of over on this side, the side where, interest rates have gone up. Banks are putting up what they consider to be some kind of roadblock. It could be deposits. We've got to have deposits on this loan or we're not going to be part of your syndication. Hey, you've got to prove this to me. And so it's a tougher sell for capital today. And it's tougher it's tougher to get the capital. It's also tougher to prove that you can pay back the capital because the rates are higher. And that is a cycle I have seen over and over and over again. And that's where you have to be really creative in raising capital. And fortunately, the United States is not a business economy that relies solely on commercial banks. There's a lot of we'll call it dry powder or capital, whether it's private investors, private equity, venture funds, friends and family, real estate investors. There's a lot of sources to do what you want to achieve, and you just got to be nimble.
Yeah. I mean, bankers, finance people are basically sales guys selling money, right? So like, I feel like as soon as the interest rates tick down a little bit, I think there's going to be a big push of people trying to put more money to work. What do you think?
Yeah. I mean, I think that's a good example. I hope I kind of hope that's the case. And, right now, I hope with the interest rates going down, it's not because the economy has gone into the toilet and the Federal Reserve really needs to start energizing the economy. But it's I don't know. I've been through so many different cycles, and there's always capital to do things that are economic. Always.
Yeah.
So,
hey, once you explain the difference between access to debt and valuations, and access to debt and the M&A activity.
Yeah, well, that's access to debt. People have said, how do you value something? Well, you value something based on the amount of cash you have in your bank and what you can borrow, right? Whatever the total of that is, that's the valuation, because most any sizable acquisition has to be financed. So that's ultimately what's going to determine the valuation. So you can say, hey, I want 20 times EBITDA until you're blue in the face. But if I can only put together, debt capital, and equity capital that gets me to 10 times, that's what it's worth.
Yeah.
So that's the way I look at it.
We've seen companies trading 20x, which is bizarre. How do you explain that?
A lot of growth. Probably not a lot of CapEx. There's unit growth, there's AUV growth, happy franchisees. Like I said before, that's probably worth 20x, but you're just going to have to come with a little more equity.
Yeah. What do you see M&A looking like the rest of this year and next year? When do you think things are going to heat up?
Well, I think they're starting to. I think it's been fairly slow. It was slow in 22, 23 was definitely slow, but I think it's starting to pick up again. From what I understand, talking to the M&A advisors and the different business brokers, I think things are picking up a little bit.
Good. Hey, if you were a franchisor trying to grow a brand, like knowing what what are some things that you would focus on to be one of the people to get one of those big multiples? Yeah,
well, it's like picking employees, picking really good franchisees, picking, really vetting your franchisees. That would be number one. Getting good franchisees in there that have access to capital, are excited about the business, want to develop. And then the second thing is I would even if I didn't own any company stores, I'd be really zealous on what the franchisees are making. I'd make sure that it's a hell of an investment opportunity for them, and I'd put them first. Think about them first, and you'll be laughing all the way to the bank if you do that.
Yeah. And then when I think about Franchise Times magazine, I love it. But it's not just food. Like I'm a restaurant guy on the restaurant board, but Franchise Times is non-food as well. Why do you see so many food guys, like even Greg Flynn, the biggest franchisee in the world, starting to expand with non-food?
Yeah. Well, I think Dan, it comes down to returns. And I think that a lot of these non-restaurant franchises have lower capital costs and higher returns. And so I think that's why you're seeing, the people moving into fitness. That's been a trend from some of the multi-unit operators. And that's, I can see that. I can see that continuing.
Yeah. The fitness also has a membership component. Imagine if restaurants had a membership component to it where you had people paying no matter whether they came in 8 or not.
Yeah. Well, I don't know. I'm wondering. Yeah. That's kind of interesting. I don't know. There'd be some restaurants I don't think I'd buy a membership to, but
Yeah, but the food, like we 2 years ago, 2.5 years ago, got approached to do a non-food brand, which we didn't really want to in the beginning, but it was COVID and restaurants were going through a weird time. We took it and it's growing faster than anything I've ever worked on. And then another one approached us. It's growing faster than that. So it's like, I think you're going to see us expand our portfolio, at least balance it out with food and non-food. I still love restaurants, and we have a bunch of restaurants that are doing just fine in this economy, but it is a little weird out there.
Dan, it takes $750,000 to build just an average fast casual restaurant in a strip center space, and so now let's take a look at something, in a different franchise that where the capital costs are less and the bottom line is good. That's where I think money will move to, and it has.
Any new trends you're seeing? Anything to look out for?
Oh, any new trends that I've seen? I think this coffee business is really interesting. All the small footprint coffee shops. A lot of multi-unit franchisees have signed up for Seven Brew or Scooters. And I think Dutch Bros has got some momentum right now. That's really an interesting area. I think that's maybe why Starbucks, might be having some sales issues, is that some of these up and coming brands are taking some share away from them. I don't know.
Wow.
I think that's an interesting area to keep a watch on.
Have you seen Salad and Go?
Yeah, I've never been to one. I know Charlie Morrison, and I just I've never seen one. I guess they're in your area, but I haven't seen them around me.
It's the same idea. It's a teeny footprint freestanding drive-through that just sells salad, and everything's pre-made. There's 2 employees or 3 employees inside, and yeah, I mean that's that. Especially with labor issues, you have to have a labor model that allows you to overpay. Like you just have to. No matter how you slice it, you got to overpay to get and keep good people. So
yeah, I mean, if the margins are good in that, I mean, look, I talked to Charlie, and I think they're selling those for, I don't know, maybe they've taken a price increase, but $8 somewhere in that range, $7, $8, $9, and my favorite Portillo's, which is a mile away from me, they keep raising the price every 2 years, and it's $13. And try to go to Sweet Green or try to go to something similar to that, and it's probably $20. So yeah. Salad and Go, if they can produce some decent margins, got a future.
Well, you mentioned also earlier Chipotle. Like Chipotle keeps raising its prices. Like you have to. Like there's no way around it unless you're going to work for free.
Yeah, I think Chipotle though has been pretty measured in their price increases. They've taken them. But I don't think it's, that's one of the things about the restaurant business. I think a lot of operators probably are regretting is that they just automatically jacked up their prices and didn't see this coming, that the customer might take exception and revolt. Yeah, exactly.
Yeah. All right. Well, so you're feeling good about the rest of the year and next year? Do you think things are going to get better?
I'm a restaurant guy, Dan, and I've watched this industry for 44 years. And there was a book written 30 years ago by a guy, and it was called Fast Food: The Endless Shakeout. And that's what's happening. I mean, day in and day out, customers decide where they're going to go, where they're not going to go. And I think that there's going to be some brands that are going to continue to lose stores, lose share, but there's other brands, like we've seen, like Chick-fil-A and Raising Cane's. They're going to continue to grow. And that's the business we're in. It's new ideas come along. They're better than the old ideas. They got fresher stores. They're appealing to a different generation. And that's that endless shakeout that's going on. And it doesn't bother me. In fact, it kind of energizes me. It energizes the way to continue to look for new stuff.
Yeah, we're looking at we have a Mexican chain we're growing with Pitbull, and a chain in Florida closed a bunch of stores. 3 of them are AAA home runs right in our franchisee's territory. He's taking them all over. He'll open those things for peanuts. And then Rubio's closed 50 or 60 stores, and we're going after 5 sites again that are AAA home runs that will wind up opening for peanuts. So it's that's a way around the issues, right? You mentioned the cost of opening up a new restaurant's expensive. If you do a conversion, and if you're careful, if you focus on your franchisees, you can still get around it.
Exactly. Yeah.
All right, John, thanks so much. I appreciate it. And I will see you at the finance conference.
Dan, thanks for having me, and good to chat with you here.
Thanks.
Take care.
Hey, thanks for tuning in to Smart Franchising with FranSmart. I'm your host, Dan Rowe. If you enjoyed today's episode, this podcast is only going to get better. Please like, comment, and subscribe to hear more from the most successful franchisors and franchisees, and we'll see you next time.